Ladies and gentlemen, welcome to a podcast with your good friends from Ledgerly. I'm Andrew. This is my good friend Mike. We're partners at Ledgerly. Recording this in the middle of December. As you can see, this nice Christmas tree in Mike's house. People gearing up for the holidays and everything. A lot of shopping going on. We're just here to talk about some of the best strategies to implement for your business when it comes to saving taxes. And we just wanted to highlight 5 key ones ahead of the year end. But with that, Mike, you want to say anything else to the folks before we get started here?
Yeah, for all you watching before Christmas, before the holidays, Merry Christmas, Happy Holidays. Here at Ledgerly, we take family seriously. So hope everyone's happy and healthy. Everyone's blessed. And without further ado, we're going to give you guys a little teaser at what we're doing for our clients right now. We're going to give you 5 of the top planning strategies that we love to do here for our clients to save them money.
That's a great segue. And yes, the 5 top ones. So what we're doing for a few of our clients we're in the middle of is a retroactive S election. And what that means is you treat your LLC, you elect to have it taxed as an S-Corp rather than having it flow onto your Schedule C on your individual 1040. Mike, you want to walk through kind of the steps about how you do that?
Sure, yeah. And I'll keep
the benefits for it.
Definitely. We'll keep it super broad level. Don't want to get into the nitty details. We just want to give you, the taxpayer, the end result of what could potentially happen. So the rule of thumb is if you're a business owner and you have roughly $50,000 or more in your net profit, meaning your net income after all of your expenses. You get gross income, get your expenses, that's what you're left with. If you have more than $50,000 in net income, we highly recommend electing this S corporation, because when you're a single member LLC, you're going to be paying about 15% in self-employment tax. When you make the S corp election, you put yourself on payroll as the business owner, as long as you're in a profit standpoint. So you put yourself on payroll, and a real good chunk of that income avoids that 15% self-employment tax. So rule of thumb, if you're bringing home money at the end of the year and you're reporting your business on your Schedule C, you're most likely overpaying on your taxes. So let's get that going for you. Let's do that retroactive S election. There's still time.
Yeah.
We need to do it before December 31st.
So that's the great thing about this strategy is it's retroactive. So you're going to be treated as an S corp starting from January 1st and for the entire year. But there's some forms you got to fill out.
Yep. And
you got to connect with the IRS, and they're not exactly the fastest about turning over things. So there's still time in the year, but you got to take action now.
Yep. Let's do it. Yeah.
And even if I know kind of the rule of thumb is, you're in a profit position for the year, it's not even unheard of to undertake this strategy before you're making profit. If you expect to turn a profit next year, go ahead, get the paperwork done now. You're going to save time and money next year doing it up front. And that's the thing that's important about it. It's going to save you money year over year. It's not like just you save money on this tax season. It would be the same thing next year. You would overpay in taxes. So you want to be treated as an S-Corp every year so long as you're making money.
Yeah. Boom. That's retroactive S election. Get in touch with us. Let's make the right moves. Let's file the paperwork before December 31st.
So that's a popular one we're doing for clients right now. It's an exciting one. But another one is Board of Directors meeting.
Yes.
Before the year end. So, Mike, talk to our good friends here.
That's one of my favorite. This is a great strategy. So, for example, Ledgerly, Andrew and I, we have a board of advisors. That can be anyone. It can be your parents. It can be your wife. It can be your fiance. Some people think their pets qualify, but no. You got to talk business. So, basically, take your family, take them out to dinner. Go on a weekend trip, as long as there is business advising and there is a reasonable business expense related to this board of directors meeting. There's minutes, there's a log of what we're talking about. The whole thing is deductible. The meals, the travel, all of that. So
And did I hear you correctly? Is that the key there? That the whole meal is deductible? It's not subject to the 50% limit?
correct. Yeah, board meetings are 100% deductible. So it's different when you're just taking a client out to dinner, whatnot. That's more regular. But a board of directors meeting, as long as it is for a business use and you're documenting and you have the right books and records in place, everything's deductible for the board of directors meetings.
And that's a great highlight. You need to have records
Correct.
to show it. So, he said there's going to be minutes that are recorded. What was discussed? Who was there? Who is on your board?
Right.
Those are all things you got to keep track of.
Exactly. So board meetings are definitely one of the top effective strategies because they're easy to do. Document your minutes. Have an attorney set it up. It's not rocket science here. We just want to give you the best and easiest way to save money on your taxes.
Yeah, so that's a great one. That's cool to do as well. Another one, opening up a health savings account.
Yes.
Now, as I understand, there's some flexibility with this one, right?
Yep. So the health savings account is incredible. When Trump came into office, he basically raised the standard deduction. So a lot of people stopped itemizing their deductions because we all know that medical falls into those Schedule A itemized deductions. So a lot of people aren't itemizing, but a lot of people are taking advantage of a high deductible health insurance plan. Some employers have HSAs, through their high deductible plan. But if you're just, kind of self-employed or have your own high deductible savings plan, you can take these monies and put them aside into this health savings account and boom, get an automatic tax deduction instead of adding everything up to see if you qualify for itemizing your deductions. So for a single self-insured person, I think the limit for 2023 is like $3,800. And then for a family married plan, married, or if you're married with kids, I think it's like $7,700, something like that. The limits are going up, but the HSA gives you the flexibility to put monies away into a quote unquote account strictly for health reasons. If you don't use it for health reasons and you just want to use it for personal reasons, you pay ordinary income tax. It's like a regular brokerage account. It's like an interest-bearing account. But if you use it for healthcare reasons, doctors, hospitals, prescriptions, the list goes on, 100% tax-free. The growth is tax-free.
Yeah. And you know what? You might be someone that's young and healthy, you haven't been to the doctor in years. Maybe it doesn't make sense, but if you're married, you have some young kids.
Yep.
One of them has like asthma or something. You're going to doctors all the time, or one of them has allergies. All these things come up. You're going to be in the doctor's office a lot, just more often when you have kids. It's just the nature of the beast. Maybe it makes sense to open up an HSA and make those contributions and then get those deductions because, as Mike called out, normally you can only deduct those if you itemize your deductions, which the majority of people do not do. The majority of taxpayers just take the standard deduction and therefore lose out on the deduction for the medical. But if you're contributing to an HSA and using that to pay for your medical, then you get the deduction.
Right. And just to put it in perspective, like you just said, that people are not itemizing their deductions. So let's say you have $100,000 in adjusted gross income. You need at least 7.5% of medical expenses in order to qualify for itemizing your medical deductions. So 7.5%, $7,500. Is everyone going to have $7,500? No.
Right. It needs to be in excess, right?
Exactly. It has to be in excess of that $7,500. So with the HSA, why not just put money up to $7,700 into the HSA and boom, you get the deduction. And like you said, hey, if you have kids that are going to be recurring medical costs and whatnot, if you know you're spending $50, $100, $200 a month on medical, put it in the HSA. The other cool thing with the HSA is if you open it now, you can go back as far as the eye can see and find receipts from doctors and prescription drugs and basically reimburse yourself from your HSA as long as you have a receipt to match it up. So you put the money into the HSA, you take it out for your personal use to reimburse yourself because you already paid that medical expense before. HSA, sky's the limit. It's one of the best investment vehicles when it comes to just medical and also just for another investment account too. So we can go on and on about the HSA. It's an exciting account, and everyone that has a high deductible insurance plan, should definitely take advantage of it 100%.
Yeah, and that's another thing. I like how you call it out there. That's another one that you can apply it retroactively.
Correct.
Yeah.
Yeah, good point.
And then, if I'm not mistaken, with the HSA, you can contribute to that up until, is it when you file your taxes?
Yeah, great point. So the HSA, you don't need to fund by December 31st.
So like with the S-Corp election, we're saying, that's something that you got to fill out and elect before 12/31. With the HSA, you can contribute it up to it until April 15th, right?
Yeah, when you file your individual income tax return. You can basically populate your return, see how you're looking. Hey, I might owe a little bit of money to the IRS. No. Let's open this HSA for you. Fund the HSA.
Hold up.
Boom.
Wait a minute.
Put a little love in it. Get that HSA rocking and rolling. Andrew, awesome point. You can do it up until you, that's why he's the CEO. Or hold up the coffee mug.
I'm here all week.
He is Mr. Right today. And I'm going to apologize in advance. Sorry what I said during tax season. Excellent point. Yeah, you can do that HSA all the way up until you file your return. So it doesn't need to be a December 31st cutoff. You can do it right at April 15th when you file your return. So, oh man, I'm juiced up from the HSA. I can go on. It's like I just funded my HSA. I'm like, boom, you know what? There's my tax write-off for the year for my wife and I. So love it.
I'll fund mine April 1st or something.
A little late to the game.
All right, enough of the HSA. Great strategy. Next one, and this brings us to number 5. We did a terrible job. We said we're going to give you 5 strategies. We listed number 1, and then we didn't even give you the other numbers. But that's okay. So we have done 4 so far. Number 5 is rental properties.
Well, actually, I thought we were going to go to shifting income and expenses. Was that number 4?
Did I skip over one?
Let's start with rental properties.
Sure.
Then we'll do the shifting. We got so excited about that HSA. Maybe we should just stop the podcast, the HSA podcast.
And that'll get its own in a future video. But let's keep it rolling here.
Alrighty.
So talk to the people about the rental property, and this is something we're working through with a client right now.
Yep, exactly. And the rental property can be on the individual side, the business side. Real quick, broad level, business side. If you're a business owner and you want to invest in real estate, you can take that piece of real estate and basically pay rent to that piece of real estate out of your business. So it's rent expense on your business, it's rental income on your property that you're investing. That property avoids the self-employment tax, getting back to the S-Corp election. So you're basically an owner-occupied piece of property. So you can pay yourself rent. Basically, it's a reclass, rent expense on the S-Corp, rental income on the real estate side. So that's a good strategy. Basically, just the do to, do from. That's we see a lot of our small business owners doing that and getting into that. On the individual side, if you're a landlord and you're a real estate professional, which those rules go sky's the limit. If you're a real estate professional, you have the option to do these cost segregation studies and accelerate depreciation on those pieces of property. And the cost segregation you can do on the individual side and or the business side if you're an owner occupied, yada yada yada. Regardless, investing in real estate, other than the tax strategies, is just a great way to go. It's for the most part, it's passive income. You're getting the depreciation. You can write off all the interest associated with it, and it just builds your portfolio. So from just a pure investment side, real estate, we're seeing a lot of our clients and business owners, investing in real estate.
Yeah, great strategy. And just to hit on a point in there, just broad level for those that don't know, when Mike's saying accelerate depreciation is an expense you take over the life of an asset. Right? So it's going to hit your income statement. It's going to reduce your taxable income. With fixed assets, we call them, with a rental property, with a building, we accelerate the depreciation. So we typically take a larger deduction for the use of that asset up front in the first few years, and then you get a smaller deduction for it as the years go on. So again, that's just if you didn't know, that's it's a great strategy, and that's something. It's going to roll right into our next point. Shifting income or expenses at year end. That's another strategy. So we might advise a client. All right, is there anything you need for your business? Any big fixed assets that you're looking to use for the operations of your business? Let's buy it before December 31st, and then let's accelerate depreciation on it, get a big deduction for it, reduce that taxable income, and you don't owe as much in taxes.
Exactly.
Like how I put the bow on that?
Oh, you wrapped it up nicely. The other thing, too, is a lot of our business clients, our business owner clients, they're what's called cash basis taxpayers, meaning that they're recognizing revenue when the cash actually comes through the door, and they're recognizing the expenses when they're paying the cash or they're swiping the credit card. So if you're a cash basis taxpayer and, let's say you have big profit at the end of the year and you get that check on December 31st, maybe it makes sense to deposit that check January 1st. Vice versa.
We could do it in a few days.
Yeah, that's fine.
Deal. Yeah. It just so happened I cashed on January 2nd. Oh, it's 2024.
Yeah. Oh, New Year's Eve. Oh, the bank's closed. I'll make my way down there later. And on the contrary, maybe it makes sense to accelerate some of those spending. So like maybe prepaying for insurance policies. Accrual basis, you're recognizing it over the 12 months. But the IRS only cares about when you pay the money and when you receive the money.
Yeah, if you're a small business, you're most likely on the cash basis method of accounting.
Yep.
So you don't have to worry about accruals and everything. That's normally for bigger companies, C Corps and whatnot.
Yep.
But yeah, and as I mentioned, is there anything you could use in your business? Maybe you need some new, office, like furniture, desks. Maybe you need new computers, whatever it is. Those are all assets you could purchase at the end of the year and then accelerate that depreciation and then lower your tax bill. And then also on the income side, if you're cash basis and you got some, open invoices with some clients, maybe don't follow up with them. Maybe you'll get it. You can get it. You could be playing with some fire there if you let them sit for too long. They just don't pay it. But
you drink a little bit too much eggnog. You forgot. You passed out. No big deal. No big deal.
I'll catch you next week.
Yeah, or next year.
Yeah. So now
stuff.
I think we've officially hit 5 strategies.
That was all 5.
I think so, right? So we started with retroactive S selection.
Yep.
Oh my God, terrible.
HSA.
HSA was definitely one. Shifting income taxes, buying a rental,
and board of directors.
Those
are
that's
5.
The one. Yep.
Well, you know what? It's a season of giving. We got the presents wrapped under the tree. Can I give him a 6th for the road?
You sandbagging son of a...
CEO, come on. It's Christmas time.
You're a nicer guy than me.
All right, fine. All right. This is really only going to be for people who live in Connecticut. However, if you don't live in Connecticut, your state might have a similar program. So this is for all you individuals out there. Connecticut has something called a CHET plan. It's CHET, Connecticut Higher Education Trust. It's a 529 plan for educational use, but it's a state-driven plan. So if you are single or married, you have the option to contribute up to $5,000 per child if you're single, or up to $10,000 per child if you're married. And that $5,000 if you're single, or that $10,000 if you're married, is a tax deduction on your Connecticut state income tax return. So it's a $5,000 tax deduction to your Connecticut income, or a $10,000 deduction. So if you're married and you have 4 kids, you can put $40,000 into this CHET account each year and get a $40,000 write-off on your state tax return, your Connecticut tax return.
And what are the CHET accounts used for?
For education purposes. So
is it only higher education or?
Yeah, college education. Yep. So community college, universities, regular colleges, undergrad, graduate degrees. The list goes on. And again, if you don't use it for educational purposes, it's still a great way to use it as an investment strategy, just like the HSA. So for all you Connecticut residents out there, the CHET account is a great one to look into. If you're not a Connecticut resident, see if your state has something similar.
I was going to say, some states do have some similar plans as well.
Yep.
But that, to his point, it's state by state. So.
Exactly. And if you're not a Connecticut resident and your state doesn't do one of these, the 529 plan, regardless, is great because you're investing into your kid's future. And if they don't go to school, it's an investment account. And you can roll that into Roth IRAs if you want that. We're not going to get into that right now.
Let's keep it at 6.
All right, let's keep it at 6. All right, we're not doing 7. All right, so there are our 5 with a nice little cherry on
half
top.
A dozen.
Half a dozen. Your baker's
You got
dozen.
6 eggs. I mean, 6 strategies.
6 is 1/2 dozen.
Yeah. Good math.
Good stuff. Good man.
Cheers to that, Mr. Wright. Well, guys, thanks for tuning in. I hope these strategies help you. If you don't know how to implement, don't go researching online, running in circles. Like, this website says this, and this website says this. Connect with a professional. Even if it's not Ledgerly, it should be Ledgerly.
Who said that?
We're on all socials, but connect with an accountant, a CPA, tax advisor, someone who knows what they're doing. They're just going to help. So what, you have to spend a couple $100 for the consult and the guidance, but it's going to save you. It could save you hundreds, or it could save you thousands on your tax bill.
100%.
Less money to the service, and more money in your pocket that you could spend on who knows what.
Exactly.
Maybe a handsome looking tree like this for your house. I don't know.
It's artificial. Don't be fooled.
You got a lot of ornaments on there.
It's all the wife. It's all Lori.
Where's my stocking?
Where's my stocking?
It's right there. What are you talking about?
M&L. We should get an M&A. Mike and Andrew, we should get a Ledgerly stocking. Hey, become a client. We'll send you a Christmas stocking.
Probably not.
Maybe. Or if you celebrate Hanukkah, we'll send.
We'll talk about it
at
our next board meeting.
All right. Good stuff, guys. Get in touch with us. Reach out. Any questions?
If you like this, please hit the like, share it with someone who you think could benefit from it, and let us know some topics you want to hear about. If you are listening to this, if you want more from Ledgerly, your good friends here, let us know what you're into. Let us know how we can help you.
Exactly.
But with that, happy holidays. I'm going to finish this coffee, and a happy new year to you as well.
Cheers, everyone. Stay healthy and blessed. Take care.